Welcome. In this video, Zbcn coin, can we increase by 1140% and multiply our money? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
An ascending trend line is one of the most important elements of technical analysis, as it supports upward price movements in the markets and indicates the continuity of this momentum. As long as the price remains above the ascending trend line, it reinforces investors' confidence and signals that the market is sustaining its bullish momentum. If the price does not break this trend line, it suggests that buyers are still strong and determined to push the market higher. Therefore, the trend line acts almost like a support level and creates a psychological barrier for investors. The fact that the price does not fall below this barrier indicates that the uptrend is continuing in a healthy manner. Maintaining the ascending trend also shows that buyers continue to show interest in the market and that sellers' attempts to pull the price down are countered by buyers' pressure. Each time the price approaches the trend line, investors see this level as a buying opportunity, causing the price to bounce back upward. This reinforces the strength of the trend both technically and psychologically. Because as long as the price does not break the trend line, most investors assume that the uptrend will continue. This very assumption itself keeps the buying pressure alive, contributing to upward price movements. If the price does not break the trend line, it further strengthens the market's momentum. Each day that the uptrend remains intact increases investors' confidence. This confidence is not only important for short-term traders, but also for long-term investors. When long-term investors see that the trend has not been broken, they tend to hold their positions and even make new purchases to support the uptrend. This allows the price to move upward with greater strength. An ascending trend line also plays a key role in risk management for investors. As long as the price stays above this line, investors can maintain their positions with confidence. Because as long as the trend line is not broken, the general direction of the market remains upward. This situation encourages investors to act more boldly. For example, seeing the trend remain intact, an investor may believe that prices will rise further in the coming days and increase their positions. This raises buying pressure in the market and strengthens upward movements. Not breaking the trend line is also critical in terms of reliability in technical analysis. Since the ascending trend line is generally followed by a large number of investors, it almost becomes a self-fulfilling prophecy. In other words, as long as the price does not fall below this line, the majority of investors continue buying. Therefore, when the trend line is not broken, the market consistently finds upward support. This support paves the way for the price to reach new highs. The fact that the price does not break the ascending trend line also creates a sense of security in the market. Thanks to this sense of security, investors' expectations remain positive. Positive expectations lead to the inflow of new capital into the market. Especially large investors, seeing that the ascending trend is preserved, do not hesitate to allocate more funds to the market. This increases liquidity and contributes to the healthier progression of upward price movements. An ascending trend line also plays a key role in risk management for investors. As long as the price stays above this line, investors can maintain their positions with confidence. Because as long as the trend line is not broken, the general direction of the market remains upward. This situation encourages investors to act more boldly. For example, seeing the trend remain intact, an investor may believe that prices will rise further in the coming days and increase their positions. This raises buying pressure in the market and strengthens upward movements. Not breaking the trend line is also critical in terms of reliability in technical analysis. Since the ascending trend line is generally followed by a large number of investors, it almost becomes a self-fulfilling prophecy. In other words, as long as the price does not fall below this line, the majority of investors continue buying. Therefore, when the trend line is not broken, the market consistently finds upward support. This support paves the way for the price to reach new highs. The fact that the price does not break the ascending trend line also creates a sense of security in the market. Thanks to this sense of security, investors' expectations remain positive. Positive expectations lead to the inflow of new capital into the market. Especially large investors, seeing that the ascending trend is preserved, do not hesitate to allocate more funds to the market. This increases liquidity and contributes to the healthier progression of upward price movements. An ascending trend line also plays a reflection of market psychology, because the price consistently making higher lows shows that buyers dominate the market. As long as the price stays above this line, buyers remain motivated. Even though sellers attempt to push the price down, the strength of the trend line makes these attempts fail. Ultimately, the market returns to buyers' control and the uptrend continues. In addition, the persistence of the ascending trend creates the basis for the formation of other technical patterns. For example, while the price moves above the trend line, various bullish formations can emerge. Patterns such as the cup and handle, flag, or inverted head and shoulders produce stronger signals with the support of the ascending trend. This increases investors' appetite for buying and ensures that the uptrend becomes more permanent. When the price approaches the trend line but does not break it, this is often interpreted as a strong buy signal, because in this case, investors believe that the market will bounce back up from this level. Thus, the trend line acts like a springboard. Each time, the price bounces off this springboard and reaches higher levels. If this continues for a long time, the trend line remains unbroken and the uptrend stays intact. In conclusion, not breaking the ascending trend line creates a positive atmosphere in the market. This atmosphere ensures that prices move upwards steadily. As long as the price remains above the trend line, investors' confidence strengthens, more buyers enter the market, and bullish momentum is preserved. The strength of the trend line is significant not only technically, but also psychologically. For most investors, the price staying above this line is a strong indication that higher levels will be reached in the future. Therefore, the price not breaking the ascending trend line is considered a very positive situation both in terms of technical analysis and market psychology. But we can't make decisions based solely on trend lines. So let's also take a look at other metrics. Stay tuned.
The rising trend structure formed on the RSI indicator is quite important in terms of understanding the momentum of price movements and the balance of power in the market. Because RSI is not just an indicator that shows whether the price is going up or down, it also reflects the intensity of buying and selling pressure among market participants. If a rising trend line has been drawn on the RSI, this indicates that buyers' dominance in the market continues more strongly and that selling pressure is gradually weakening. When the RSI touches this rising trend line and bounces upward, this is considered a very positive signal from a technical analysis perspective. The indicator is essentially telling us that even if the market has made a short-term correction, the main direction is still upward, and if this trend is maintained, the bullish move can continue even more strongly. The RSI bouncing from its rising trend line actually shows that the price has been strongly supported by buyers at a psychological support area, and that there has not yet been a breakdown to the downside. These types of moves restore confidence in market psychology and increase investors' tendency to hold on to their positions. It also makes it easier for new investors to enter the market because technically, maintaining an uptrend is perceived by many as a reliable sign of continued upward momentum. For this reason, such bounces on the RSI not only have technical importance, but also provide psychological support for the market. For prices to continue rising in this scenario, the RSI must not lose this trend line, because if the RSI loses its rising trend, it would indicate a weakening of momentum in the market. However, in the situation you mentioned, if the RSI bounces off the trend line and moves upward again, this can be interpreted as a kind of consolidation or recharging. In other words, the market may have taken a short break. Sellers tried to push the price down, but buyers acted more strongly and regained control of the market. This is a very positive sign that a long-term uptrend could continue. Additionally, the RSI bouncing off this trend line allows price action to continue rising in a healthier and more balanced way, because prices that go up vertically in a straight line are usually unsustainable. Periodic pullbacks and touches to the trend line give buyers new opportunities and help relieve overbought conditions in the market. This way, the market can form a longer-term and more sustainable uptrend. Especially when RSI values remain above the 50 level, combined with these kinds of bounces, they confirm the market's strength and the health of the upward trend. The RSI bouncing off its trend line also offers investors important opportunities in terms of entry points, because many investors don't only look at the price chart in technical analysis, but also make decisions based on the signals given by indicators. The bounce on the RSI uptrend is considered by many investors as a buy signal. This can trigger a new wave of buying in the market, paving the way for prices to move upward more strongly. Moreover, these kinds of bounces generally produce much stronger results when supported by volume. If the RSI bounces upward from the trend line while trading volume also increases, it shows that the rise is driven by genuine buying interest, which strengthens the reliability of the trend. At the same time, these kinds of rising trend bounces on the RSI provide valuable insights not only in the short term, but also in medium and long-term analysis, because they show that there has not yet been a deterioration in the market's fundamental dynamics, buyers are still in control, and prices can continue to move upward in the bigger picture.
When we look at the logic behind the pennant formation, we are actually talking about how market psychology is very clearly reflected on the chart, because this formation usually appears after a strong and steep upward movement. First, the price moves sharply upward, and then a short period of narrowing consolidation begins. This consolidation often looks like a small flag or pennant and represents a phase in which the price is gathering strength for another strong move. That's why analysts and investors pay close attention when they see pennant formations, because the moment the price breaks the upper line, it actually signals that the consolidation phase has ended and that buyers have regained control. When the upper line is broken, the pennant has officially started to play out. This breakout usually occurs with high volume because market participants know what these types of formations mean. Rising volume also proves that the breakout is not fake, in other words, not a trap. If the price breaks the upper line strongly, in technical analysis, the target of the formation is measured by the length of the flagpole. In your example, this length points to an increase of 1,140% compared to current prices. This means that if the price breaks the upper line and the formation plays out, theoretically, the price could rise as much as 11 times. Of course, the important thing here is that this target is only an expectation that comes from technical analysis. There is no rule that says the price will definitely rise by 1,140%, but because such formations have worked many times throughout history, investors take them seriously. Pennant formations are usually considered continuation patterns. That means the existing trend is expected to continue in the same direction. If the trend is upward and the pennant breaks upward, it is assumed the rally will continue. That's why investors, especially in bull markets, see these formations as golden opportunities. It should also be noted that pennant formations can often be seen on smaller time frames, but the strongest signals appear on long-term charts. Pennants formed on daily, weekly, or monthly charts can provide very large returns for investors. As you mentioned, a massive target like 1,140% likely points to a formation that has formed on a longer time frame, because such big percentages are usually not seen on short-term charts. At this point, long-term investors are keeping a close eye on these kinds of setups, because such a breakout is not just a short-term trading opportunity, but also mean the start of a major trend. From a psychological perspective, we can also see why this formation works. During the pennant, there was usually an atmosphere of uncertainty in the market. After a sharp rally, people start asking, will it go even higher or will it fall from here? A balance forms between those who want to take profit and those who want to buy in. This balance turns into a narrowing structure on the chart that looks like a pennant. During this time, the market is actually gathering strength. It's like a bow being drawn. The breakout of the upper line is like the arrow being released from the bow. Because uncertainty disappears, buyers take control and the price quickly moves toward the target of the formation. That's why pennant formations are often signs of sudden and sharp rallies. If an increase of 1,140% were to happen, this would not only mean that the technical analysis has been validated, but also that huge confidence has been established in the market. Because for a price to increase 11-fold, massive demand is required. This demand can only be created if both small investors and large funds enter the market strongly. This means that when the breakout happens, not only technical traders, but also investors who believe in the fundamentals will take positions. In such a scenario, the price rise snowballs and technical targets are reached much more easily. There is also a well-known saying in technical analysis. The formation target is the minimum target. This means that while the pennant is expected to push the price by the length of the flagpole, most of the time the price can even exceed this target. If the market is in a very strong bull phase, the price may not only reach the pole length, but go well beyond it. In other words, the 1140% increase is not just a possibility, but also a baseline expectation. On top of that, even higher returns are possible. It's also important to remember that such a huge upside potential affects investor psychology, because when market participants see this kind of possibility, many of them start buying even before the breakout. This can cause the price to rise somewhat even before it gets close to the upper line. Then, when the breakout happens, those who had not yet entered rush in to buy. This pushes the price much higher much faster. In other words, the 1140% target is supported not only technically, but also psychologically. In conclusion, the pendant formation is considered a very strong structure in technical analysis. As you mentioned, once the price breaks the upper line, a new upward potential equal to the length of the pole is created, and this means an extraordinary increase of around 1140%. Scenarios like this always fascinate investors because they look like once-in-a-lifetime opportunities. Technical analysis doesn't give us certainty, but it does measure probabilities. The probability given by the pennant formation is taken seriously because it has worked many times in the past. If this formation works again this time, the market could truly witness a historic rally, and this 1140% increase may not just be a number, but a realized story.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.